$44.8 billion for mayonnaise and garlic powder. Tell me again how tech is the only sector doing megadeals.
It's not just garlic powder, Nate. Though Unilever taking $15.7 billion in cash and keeping 65% equity is wild.
They get to have their cake and season it too.
Oh, please. You spent all morning workshopping that.
I absolutely did. We'll get to the Two Harbors drama in a minute.
Right. But first, let's see how McCormick actually plans to pay for this giant spice rack. The rundown.
$39 million, that's literally it.
I know. The stock popped 30% on the news, which tells you exactly how desperate those investors were for an exit.
American Exchange Group is picking up Allbirds for the price of a decent penthouse in Tribeca. I remember when every single VC in Silicon Valley was wearing those wool runners to board meetings. Now they're just a $39 million rounding error.
Speaking of dramatic pivots, Two Harbors officially dumped UWM.
Finally.
They terminated the existing deal and took the superior $10.80 per share offer from CrossCountry. You read the filings. They basically tripped over themselves running to the new buyer.
Brutal. But you take the cash. Speaking of cash, Primoris just dropped $422 million, all cash, for PayneCrest Electric.
Which is purely a data center play. And right next to that, DigitalBridge and Jexi are carving out data center assets from NEC to build a brand new standalone platform. Analysts keep calling the M&A market K-shaped right now, heavy favoring for US tech megadeals.
Because traditional companies are panicking. They're aggressively buying AI and data infrastructure because they know they can't develop it organically. It's the classic gold rush analogy. You don't mine the gold, you sell the server racks.
Well, Biogen is trying to mine the gold. They're buying Apellis Pharmaceuticals, $5.6 billion in cash, plus contingent value rights, to beef up their rare disease portfolio.
Which is a brilliant strategic move. Apellis gets them instant scale in immunology.
Oh, come on. You know how I feel about CVRs. Contingent value rights are just a polite way of saying the buyer and seller are fundamentally deadlocked on valuation.
I completely disagree. CVRs bridge the gap. It's a highly rational risk-sharing mechanism for unproven clinical pipelines.
Nate, it's banker fairy dust. You're just hiding your valuation argument in a footnote that nobody has to look at for 3 years.
Sometimes the fairy dust gets the deal signed. Look, you want hard numbers? Global Infrastructure Partners and EQT are teaming up to acquire AES Corp. $33.4 billion, no fairy dust required.
Absolute monster transaction. And a quick note for the calendar, Worthington Steel officially crossed the minimum acceptance threshold for Kleikner's offer. Holdouts have until April 14th, 2026 to tender their shares.
Which perfectly tees up our main event. Because if you thought a $33 billion infrastructure play was heavy, wait until you hear what's happening in the grocery aisle.
$44.8 billion of flavor. McCormick is completely rewriting the Unilever recipe, and wait until we get into how they structured the equity on this one. The big one.
I just keep picturing the boardroom pitch for this. Someone literally stood up, straightened their tie, and said, "We're going to build the preeminent global flavor powerhouse."
And then they slapped a $44.8 billion price tag on that exact phrase.
It is a staggering number for spices and condiments.
Well, McCormick is combining with Unilever's entire foods business. So yes, spices, but also a literal mountain of mayonnaise and bouillon cubes.
The financial engineering here is what caught my eye. Unilever and its shareholders walk away with $15.7 billion in cash.
Plus a 65% equity stake in the combined company, which means Unilever is not really walking away at all. They're just handing the keys over and letting McCormick drive the boat.
You say handing the keys over, I say brilliant portfolio optimization. Unilever gets a massive cash infusion to deploy elsewhere, and they keep the upside on a new standalone entity that is projected to generate $20 billion in revenue.
But where is the actual growth coming from? I read the historicals they filed. These are mature, slow-moving categories. You do not magically create double-digit organic growth just by smashing two giant pantries together.
I completely disagree. This is not a growth story, Maya. This is pure margin play and raw pricing power. When you control this much shelf space, you dictate terms to Walmart and Kroger. The cost synergies alone are going to be massive.
Synergies is just a polite word for firing middle managers in the supply chain.
Hey, I used to model those synergies. We love a good headcount reduction.
I know you do. But look at who really wins here. Unilever is basically outsourcing the messy work of cost cutting to McCormick's management team while keeping 65% of the upside. It is a brilliant play by Unilever. I am just highly skeptical that McCormick isn't overpaying for the privilege of doing the dirty work.
Come on, think of the product innovation. We are absolutely going to get Old Bay flavored Hellmann's mayonnaise out of this.
Oh my God. Please tell me that was not an actual bullet point in the investor deck.
Give it 6 months. It will be on an end cap at your local grocery store. I'll send you a jar.
I will respectfully decline, but this whole transaction perfectly illustrates what analysts are calling the K-shaped M&A landscape right now.
Right, the market is splitting. It heavily favors these massive defensive mega deals.
Exactly. It is either $40 billion consumer consolidations or traditional companies aggressively buying up AI and data infrastructure because they cannot build it fast enough organically. There is zero middle ground right now.
Speaking of that infrastructure land grab, the premiums being paid for anything touching a data center are getting wild.
You are looking at the Primoris deal.
$422 million all cash just to expand their data center capabilities. And that is barely the appetizer compared to what Global Infrastructure Partners is doing today. Voices. I am officially declaring a moratorium on the letter K. Every analyst note this morning is calling the M&A landscape K-shaped.
Because all the money is flowing up to massive US tech megadeals while the middle market flatlines. It is not a terrible metaphor.
It is lazy, and it completely ignores what is actually driving volume right now. It is not just tech megadeals. Look at infrastructure. You have Global Infrastructure Partners and EQT teaming up to buy AES Corp for $33.4 billion. That is concrete and power lines, Maya, not software. Not.
But power lines for what, Nate? Data centers? The analysts are not totally wrong when they say traditional companies are panic buying AI and data infrastructure rather than building it.
Panic buying is a strong word.
I read the Primoris Services press release. They are dropping $422 million in cash on PayneCrest Electric. Why? Specifically to expand their data center capabilities. DigitalBridge and Jexi are carving out NEC's data centers right now too. Everyone is just buying shovels for the AI gold rush.
Okay, fair. But not everything is a data center play. Some people are just buying cheap shoes. Did you see the Allbirds news?
Oh my God, $39 million.
Yep. American Exchange Group is taking them private. The stock popped 30% on the news, which is hilarious because $39 million is basically what they used to spend on marketing in a single quarter.
I remember reading their IPO prospectus. They were valued at over $4 billion. Talk about a K-shaped curve. The line just went straight down.
See, you love the letter K.
Do not push it.
Speaking of holding out for a better reality, we need to talk about what is happening with Worthington Steel tomorrow. Spill the tea. I am wearing a pair right now. That is the saddest part of this whole thing.
Look down at your feet, Nate. You are wearing a piece of a $39 million company. That is the entire buyout price for Allbirds. $39 million.
From American Exchange Group. A 30% stock pop on the news, which sounds great to retail investors until you zoom out on the chart and realize it looks like a double black diamond ski slope.
More like a sheer cliff. I read the release this morning. It is just brutal. They were valued at over $4 billion a few years ago. Now they are selling for the price of a nice penthouse in Tribeca.
Hey, I still believe in the wool shoe narrative. They had a great product. They just overexpanded retail too fast.
Oh, come on. They were venture-subsidized slippers. The market finally stopped pretending a shoe company was a tech stock. You cannot code a better soul.
Spoken like a true former tech reporter. But speaking of brutal breakups, did you see the Two Harbors filing?
The UWM termination, yes. Talk about leaving someone at the altar right as the music starts.
Two Harbors officially dumped UWM to take a $10.80 per share offer from CrossCountry. I would pay good money to read the banker emails going back and forth on that one.
I actually looked at the termination fee language. UWM is getting a breakup fee, But cross-country swooping in with a superior cash offer just validates this whole K-shaped market theory analysts keep quoting.
Exactly. The big get bigger, the cash-rich bully the weak. If you have the balance sheet, you can just blow up someone else's signed deal.
Which brings us to the steel sector. We are tracking another aggressive play for tomorrow. Worthington Steel just officially crossed the minimum acceptance threshold for Kluckner and Company's offer.
Right, but do not count out the drama just yet. The holdouts have an extended period until April 14, 2026 to tender their shares. We need to see if those holdouts try to squeeze out a premium. Tomorrow's radar. I'm keeping a very close eye on the Two Harbors drama tomorrow morning. Terminating UWM to take Cross Country's $10.80 a share is just brutal.
Brutal or just obvious? 1080 is clearly the superior offer. I'm actually watching the Worthington Steel holdouts. Kluckner officially hit the minimum acceptance threshold today.
Oh, come on, who cares about steel holdouts right now? The M&A landscape is entirely K-shaped. If it isn't a tech megadeal or a data center play, no one is paying attention.
I'm paying attention. The remaining holdouts have an extended acceptance period until April 14th, 2026 to tender their shares.
Wait, 2026? Are you joking?
I checked the filing 3 times. 2 full years just to sit on their hands. It's a gorgeous structural quirk.
You and your structural quirks. I'd rather watch paint dry than track a 2-year tender period. You monitor the steel footnotes. I'll be waiting to see if UWM actually counters.
Deal. We'll see whose radar pings first.